Report says, despite robust demand, aluminium makers are staring at intense compression in operating margins to the tune of 1,200 basis points to 22 to 24% this fiscal due to lower realization and higher production cost. However, a Crisil report sees aluminium companies maintaining robust operating profits due to healthy domestic demand. Operating margin of primary aluminium producers is expected to decline more than 1,200 basis points this fiscal to 22 to 24% from a decadal high of 36% last fiscal, due to lower realizations and higher cost of production, mainly power, Crisil said in a report on Monday. Aluminium producers saw record earnings last fiscal on the back of strong realizations. Prices reached a historical high amid post-COVID economic recovery, with the global aluminium market turning supply deficit. In the current fiscal, however, operating margin is seen retreating past levels, but will still be higher than the average of 17% over fiscals 2017-21, said the report based on the analysis of 3 companies, which account for the entire domesticity of 4.1 million tons. In spite of the moderation in margins, operating profit may remain past 5-year average, partly due to strong demand growth of 6 to 7% on-year mainly from the power and construction sectors. The two sectors comprise 70% of total sales volume. For primary aluminium makers, profitability is a function of global and domestic factors that affect prices and costs. London Metal Exchange, LME, prices for aluminium have fallen 40% from its March 2022 peak to $2,300 now primarily because of the extended lockdowns in China and the growing recessionary pressures impacting global demand. On the other hand, global supply remained robust driven by production increases in China, which controls 55% of global capacity, and of power restrictions. According to Ankit Haku, a director at the agency, prices are expected to remain range-bound around current levels in the second half, supported by lows at LME and recent production cuts in Europe, which may partly offset the impact of higher Chinese production. Overall, global demand is expected to contract 1 to 2% this year, after growing over 5% in 2021, against an expectation of a moderate growth in global supply this year. As a result, LME prices will average USD 300-500 a ton in 2023, down from $2,774 per ton in 2022. And the domestic realizations are expected to dip in sync, as they are driven by the landed cost of imports. However, production cost for domestic producers may rise 10% due to rising coal prices. The cost of power, shooting 30 to 35% of production cost, is projected to increase the most among all costs, by 40%, fueled by an increase in energy demand and disruption in global supply chains brought on by the Ukraine war. Producers rely on market purchases for 30% of their coal demand. Further, for linkage coal, materialization will be lowered this fiscal as priority is being accorded to the power sector. Despite the increase in input cost, the cost for domestic producers is still among the lowest in the world, driven by highly integrated operations with 70 to 75% backward integration, on average. As a result, domestic producers currently export over 60% of their annual output, and an average of 50% over the past 5 fiscals. According to Ankush Tiogi, an associate director at the agency, producers are increasing their smelter capacity by 30% and alumina refinery capacity by over 100% along with increase in these over the next 5 fiscals, at a total capital outlay of 70,000 rupees crore to meet the growing export demand along with healthy domestic demand from and renewable energy sectors.